What is inflation? Inflation is a sustained increase in the general price level of goods and services in an economy over a period of time, resulting in a decline in the purchasing power of money. Inflation can be caused by several factors. Before we go into these, it would mean a great deal to us if you could subscribe to the channel. So, the factors that most typically cause inflation include an increase in the money supply, a decrease in the supply of goods and services, or an increase in production costs. Inflation is typically measured by a price index, such as the Consumer Price Index, which tracks the prices of goods and services consumed by households. High levels of inflation can have a number of negative effects on the economy, including reduced economic growth, increased uncertainty, reduced customer and business confidence, and decreased international competitiveness. Central banks and governments typically take measures to manage inflation, such as adjusting interest rates or implementing fiscal policies to manage the money supply. So, how can inflation affect you? Let's assume your monthly income were to somehow double. Congratulations, you can now for the most part afford to buy twice as much as before. But what if the monthly income of everyone else were also to double? Well, in that case, you'd no longer be able to buy twice as much stuff because since everyone else also earns twice as much, then there would be twice as much money chasing roughly the same number of goods. Let's look at this in a little more depth. What if your income doubles, but the income of everyone else triples? Well, in that case, you'd actually become poorer. Why? Because making twice as much money is not enough to keep up with everyone else, who now makes 3 times more. If there's an overall increase in the price of goods and services of 10% this year, then you'll have to earn at least 10% more than last year to avoid becoming poorer in real terms. So, inflation can affect people differently. For example, those who have savings in cash or fixed income investments like bonds may see their purchasing power decline as inflation rises, while those who own assets like real estate or stocks may see their value rise. Inflation can be particularly harmful to low-income households, as they may have less ability to adjust their consumption patterns in response to rising prices. Therefore, central banks often aim for a target rate of inflation, typically around 2%, as a way to balance the benefits of price stability with the need to support economic growth. Our next video focuses on how you can measure how well you're doing financially, and it's better than you'd think. Click the link here. Thank you so much for watching. Please subscribe to the channel and hit the notification bell to be notified when our next videos are out.